This world is not fair. The financial system is built in a way to profit a few people while the masses are losing. Now the propaganda is that we simply just buy into an index ETF, into the S&P 500 a little bit every month, and then by the time we retire, we will be millionaires, we will be rich, we will be comfortable. It's all about forgetting the short term, just looking at the long term. When prices go down, just buy more because stocks will recover over time. And all of those statements seem to be logical. They seem to make sense when we look at the charts. But we have to connect the dots. Now this is the S&P 500 over the long term. It's starting in 1871. And of course, this goes up over time. And every dip that we see in this chart seems to be a great buying opportunity if your time horizon is long enough. Now this is the chart on a linear scale. Here we've got the same on a logarithmic scale. And again, it shows the same story. Sometimes stock markets can go down by 50%, but that's the time to buy. Now, why am I saying that this is propaganda and that this approach will likely not going to benefit you? The reason is monetary debasement. The reason is inflation. It means that over time the dollar is worth less and less. Now there is the officially measured inflation rate, and intuitively we all know that whatever is measured officially seems to not reflect what's going on in reality. And I agree, I think this is true. Here are the official numbers. This is the inflation rate since 1971, and this dotted line over here, that's the average inflation rate. It's 3.3% over all of those decades. Now the stock market appreciates faster than 3.3% per annum, right? It goes up by roughly 7% per annum. So what's the problem? Doesn't make sense to just buy stocks all the time. Here is the issue. This is the money supply over time. It is USM2, and it looks quite similar to the S&P 500 over time, doesn't it? Just with a bit less volatility. Now again, we can plot this on a logarithmic scale to see the percentage changes over time, and this grows, surprise, surprise, by 6.8% per annum. So very similar to how quickly the S&P 500 is growing. Now, I hold the opinion that the US dollar is indeed depreciating by 6.8% per annum. Now, not all consumer goods go up by that percent, because over time it becomes easier and easier to produce a certain good. There is technological progress, so there is a force against that monetary debasement. But if we look at assets that are rare, that can't get mass produced, those assets tend to go up by 6.8% per annum, as land, for example. And so this is then the S&P 500 relative to the debasement, relative to the 6.8% per annum. Now, do we really gain purchasing power over time by buying the S&P 500? I am not so certain. Yes, on top of this performance, we also get dividends, but we also have to pay potentially management fees of funds, and we also have to pay taxes. After all of those costs, is the average investor really going to make money by just buying the S&P 500 all the time? Don't worry about the crashes. They are buying opportunities. That's what they say. But do they also say that relative to the monetary base, the S&P 500 can fall by 74%, and that it can take 36 years in the worst case to get the money back? The number in the bank account really doesn't matter, right? It doesn't matter if we are millionaires or billionaires. All that matters is how much power do we have to buy certain things. And yes, consumer goods get cheaper over time, as one might expect, but land is not getting cheaper. Cutting edge healthcare is not getting cheaper. Education is also not getting cheaper. All the things that are somewhat exclusive, they appreciate by 6.8%. Their prices go up with monetary debasement. And so this chart then tells us a whole different story, right? Does it really make sense to not care about where stocks currently are? If you're talking about 30-something years just to get the purchasing power back, then maybe sometimes it makes sense to own other things besides stocks. Maybe we have to look at stock valuations. Maybe sometimes it makes more sense to be heavily invested in gold, or to be heavily invested in property, or whatever asset class we can think of that's not so correlated to the stock market. I mean, just by considering this chart, it doesn't really look that attractive to be now heavily invested in stock. Now, this is the S&P 500 relative to the money supply, but we can also look at other denominators. Again, if we don't use the US dollar, that becomes worth less over time. But we actually look at stable assets as a comparison, we get a more realistic picture. This is the S&P 500 relative to gold. Now from 1929, it took until 1959, so another 30 years to get the purchasing power back relative to gold. From 1971, it took until 1997, so 26 years to get all the money back. Now, of course, if we dollar cost average and we also take advantage of those low prices and potentially our career progresses over time, we tend to make more money every year because we're climbing the corporate ladder, because we become better with our skills, etc., because our business grows. Then we are going to buy more at the bottom here than we did at the beginning. So in the end, in this scenario, we would still get ahead. But now think about the opposite, right? Let's say you started dollar cost averaging in 1942 and stock prices went up and up and up, and you're very, very happy about your investment gains. You're allocating more and more of your net worth to the stock market because now again, your career is growing. And then comes the big crash. Now you're completely screwed. So there's a case to be made to potentially own more gold than stocks when we are high, and to own more stocks than gold when we are low. And currently, in the grand scheme of things, right, this chart starts in 1884. So this is 150 years of data almost. We should rather own more gold than stocks. So relative to the money supply, the S&P 500 is expensive. Relative to the gold price, the S&P 500 is expensive. And also relative to its future earnings, the S&P 500 is expensive. So this here is the Shiller PE ratio. It's a 7-year moving average of the price to earnings ratio of the S&P 500. Because when we buy stocks, we buy the company's future earnings. And the current price relative to the future earnings, that's a ratio that should stay somewhat stable over time. So when the Shiller PE ratio is high, the market cap of stocks is high relative to the expected earnings. When this is low, we tend to get a steal. And again, right now, across the entire S&P 500, we've got a Shiller PE of 35. It takes 35 years of the current earnings to become break even when buying a stock. But again, right, this is not looking at the monetary debasement. Now, I'm not advocating to just YOLO and to spend whatever we earn and to forget about investing altogether. The only thing I'm saying is that it does make sense to not just blindly buy the S&P 500, but to take the time to figure out, should I really historically buying the S&P 500, or are there potentially better opportunities out there? This picture is totally skewed. Yes, you are getting your US dollars back after a while, but the US dollar after that while is worth much, much less. If the money debases by almost 7% every year, if you get the same US dollars back after 13 years, you have lost a ton. To be exact, it's 45% roughly. The market is clearly quite heated. This here is the Nasdaq 100 relative to the S&P 500. So how expensive are technology stocks, or the most risky of the stocks, relative to the entire stock market? And yes, technology stocks tend to outperform regular stocks long term. This has two reasons. First of all, there's more volatility in technology stocks, and that volatility does get compensated to a degree. So taking on more risk does translate into getting more return long term. This chart, by the way, starts in 1985. But we're also seeing this ratio increase over time because technology stocks tend to pay out much less dividends. And the S&P 500 is a price index, not a performance index. And so whenever there's a dividend payment, this reduces the index value. So the higher the payout ratio is, the worse this is. This pump and dump that we see in the middle, that's, by the way, the .com bubble. I'm not saying that the Nasdaq 100 cannot outperform the S&P 500 long term. I'm only saying that we're very close to the all-time high again. And this does not necessarily speak for buying heavily into AI stocks and into Nvidia, etc. at the moment. This is the problem with this system. The reason why stocks go down when there's bad earnings, etc., is because the few people that know how the game works, they are selling fast enough and they generate alpha. The people that just randomly buy, say once a month for any kind of price, they're the ones that just get the average return, and the average return is just monetary debasement. We're really not earning anything. Yes, you might be able to buy more consumer goods over time because they get cheaper, but for things that really matter, right, like education for your children or healthcare, those kind of things do go up with 6.8% per annum. If the minority of people make all the money and the vast majority of people can barely catch up with monetary debasement, what that means is that we have to learn how to become part of the minority. We cannot just afford to set and forget. We have to be a bit smarter than the average person. And that means buying things that have more upside potential long term, like Bitcoin, for example, especially after it crashes. It means being risk off if stocks are very expensive, by potentially something like gold or silver. It also means to be smart with portfolio weightings. Do not just have a fixed allocation to an asset class, right? If we believe that historically stocks are now very expensive, we should probably have less of a portfolio allocation compared to when we think they're very cheap. So instead of just having, say, 50% of net worth in stocks, we might want to have between 20 and 70% in stocks, depending on where we are in the grand cycle. So let's drive this point home again with the S&P 500 relative to gold. We never want to be only in the S&P 500 or only in gold, but when the stocks are expensive, we maybe only want to have 20 or 30% allocation. And we potentially want to own more gold than stocks. And when we then historically crash, we want to sell our gold and buy gradually more and more stocks as we go down. And then at the bottom, we might want to have 70 or 80% in stocks. So we're just riding those moves. We don't try to time the top and the bottom perfectly. We're just adjusting our portfolio weighting as we're going up and down. And again, we don't want to have a fixed ratio, right? We want to adjust our gold to S&P 500 ratio based on the relative valuation. Now, this is just an example, right? The whole thing also works with property and with crypto. Assets are volatile and we have to be opportunistic about what's currently cheap and what's currently expensive. We should not be a gold bug like Peter Schiff, but we also shouldn't just buy the S&P 500 all the time, as David Ramsey might suggest, for example. We want to be smart about what we're doing. We don't want to be hyper-focused about a single asset class and dismiss everything else. Now, to a degree, the crypto market is just a reflection of unregulated life. As in, most gains come just to a few people, to a few assets. The vast majority tends to lose. So if we're just taking a broadly diversified portfolio of assets, we're likely going to not perform that well. Because here's the thing, crypto does not have any regulation. Everybody can launch a coin, and so there's no real barrier to entrance. And because of that, we tend to see a lot of fraud. We tend to see a lot of setups where tokenomics are rather poor, so where the average investor tends to not make money. And so when crypto cannot create money out of thin air, when it's actually a sophisticated system of moving money from the not so well informed to the better informed, then how can we become better informed over time? Because surely there's also a luck component involved, but there are some people that tend to win long term. Now, it's obviously not easy to become part of the minority. If we are not launching a project and we know more than the rest about that project, then how can we still become insiders? I think the best answer is to try to figure out what the insiders are doing and then simply copy trade them. For example, over here, we've got the Martini guy, and he bought the Chippy token when the market cap was still at $455,000. Now have a look at the comments on that wallet signal. The Martini guy tweeted about Chippy 2 hours after he has bought himself. And so since we are in a market without much regulation, and since we are in a market that does not produce any wealth, it's just transfer from one to another, it's all about figuring out an unfair advantage. And the unfair advantage of Martini guy is to simply have a following, right? He's just buying and then he tweets about it and then the price goes up by more than 50% in just a few hours. Here's, by the way, his YouTube channel. He's got 150,000 subscribers. And so when we know what the insiders are doing, when we know what the influencers are doing, we can replicate those trades. Now, the art is in finding the right wallets. And we are tracking 12 wallets of Martini Guy. In total, we are tracking more than 500 wallets. So 12 are by Martini Guy, but we've got a lot of other influencers as well. For example, check out this signal over here. This is YouTuber Jesse Eckel. He bought $10,000 worth of the winner token on the 2nd of May. And surprise, surprise, on the 6th of May, he published a video about the winner token. And so, of course, the price also appreciates in the top by almost 50%. And so really, it's a game of attention. It's not a game of fundamental analysis. Most YouTubers, they simply just buy the asset and then they promote it on their channel. And then later on, they might sell it at a higher price. Don't get distracted by all the noise. We are also following Alex Becker, for example. So we've got 12 of his wallets. We are tracking Crypto Banter. We've got 33 of their wallets. And here we've got Brian Young, who, by the way, bought the virtual token extremely early. And we've got 5 of his wallets. So how do we get all of that data? How do we know what influencer holds what kind of wallet? And how can we then create those signals that we can actually buy and sell with them? The answer is through on-chain analytics. So there are several approaches. We can, for example, look at what kind of NFTs does somebody hold. We can then see, are there maybe potentially deposit addresses on centralized exchanges? Did other major deposits happen to the same kind of wallet? Are those wallets potentially connected? We can also look at prior purchase histories. So let's say we've got an influencer that talked about very small altcoins in their Twitter or in their YouTube. And then we look at wallets that held all of those altcoins and that potentially bought them also before the tweet or before the YouTube video. Then we've probably also got the right wallet. We can then afterwards confirm this, right? We can look at what is the wallet buying next. Is there again another tweet or another YouTube video on this? If the answer is yes, it's probably the right thing. We're then continuing to track it. And so I've made an entire video playlist on how to find different wallets and how to track them, how to then get the signals and how to interpret the signals. And so our entire community is trying to find new wallets, discussing this in the wallet research channel. And then once we found an agreement, we add this to our influencer trade tracking channel. And so the idea is pretty straightforward. We're trying to generate as much outperformance as possible that in the end, the membership more than pays for itself. Now there is some funds needed, right? We can't just trade with a few $100s. I think the best portfolio has at least $5,000. Once you are at 5,000, you should be able to make that money back. Now, if your portfolio is larger, then you can consider to potentially sign up for yearly as well. First of all, there's a discount involved. So there's $250 off. But secondly, there's also a 1 hour free Zoom call. So in case you've got a larger portfolio in crypto, but also outside of crypto with other asset classes, and you could benefit from a direct one-on-one call, the yearly membership might be for you. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.